We're back with more Seattle Real Estate Radio with your hosts, Christian Nossum and Dan Keller.
Hey, welcome back to Seattle Real Estate Radio on KKOL 1300 Business Radio. Hey, we are here every single Monday from 3 to 4, just a quick reminder, and on Saturdays from 5 to 6.
That's right.
Every single Monday and Saturday now.
That's right. We're on twice.
Twice a week, baby.
Simulcast. We're live Mondays, but they rebroadcast on Saturdays.
Yeah.
So.
Well, we have a phenomenal guest here. I'm excited today. I can't wait. I know you're going to manage and run with it, starting out at the gate, but it's going to be great.
We got a lot to cram in, so we're going to get going. So today we have Matt Ross. He is a financial advisor and owner of the Ross Financial Incorporated, an independent firm aligned with Raymond James Financial Services, Inc., member FINRA, SIPC. It's like compliance.
Kind of like me, just compliant. Over compliant right
exactly.
here. Exactly.
Matt has been helping people make sound decisions with their investments and finances since 2005. His practice is located in the Mill Creek Town Center, and he focuses his practice in the area of retirement planning. So, Matt, thank you very much for coming on today. I appreciate you taking the time and your willingness to share all this great info with us.
Absolutely. Thanks for having me.
So can you shed some light on retirement planning for our listeners? I feel like a lot of people confuse the title of stockbroker with financial advisor, and I don't know what the difference is, so maybe you can enlighten us.
Sure. I'm happy to. You know, I think a stockbroker is kind of an older term that people use to describe somebody who, spends a lot of time picking certain stocks at certain times, with really an emphasis on returns. Mm-hmm. These are individuals that, seem to be more portrayed in like Hollywood movies.
Yeah, it seems like a very 80s term to me for some reason.
Sure. The most recent one, The Big Short. It's, and so, very glamorous, I guess, which I would say that what we do isn't glamorous, but, our focus is more on planning. Mm-hmm. We meet with people and spend time understanding their goals, what they want to accomplish with their money, and putting together a plan to accomplish those goals.
Got it. Sounds pretty straightforward, not very complicated.
And professional.
Exactly.
You're not a broker. I just feel like even in my industry, mortgage broker, I just feel like broker has that...
Yeah.
A little dirty,
rubbing off your skin a little bit.
Yeah. I don't like them. You call me a mortgage broker every once in a while. I'm like, dude, I'm an advisor.
I don't know what that
mortgage advisor.
Yeah. I'm sorry, Dan. So, why do people, or do people really need to use a financial advisor? I mean, everything's online, it seems like. So, do you really need to use one?
Yeah, I mean, it's a fair question, and I will say, no, not everybody needs to use one. Okay. But just like with any profession, there's a lot of people that feel more comfortable in the hands of somebody capable that performs their specific skill day in and day out. Mm-hmm. Most people I encounter don't want to make a mistake with their retirement.
Mm-hmm. Yeah,
I don't.
Doesn't sound like fun.
No.
It's kind of
you only got one shot at it, really. Right. I mean, so you don't want to screw it up. I mean, I certainly wouldn't want to manage mine.
Yeah. So what types of things do you guys help people with, or what do you help people with?
Yeah. So a little bit more detail is the fact that I review people's retirement plans at work to help make sure they're diversified, and in line with their stated risk tolerance. Make sure that based on their specific situation that they're putting away enough money. I review IRAs and do the same thing regarding diversification and risk, but we also analyze what types of investments they have inside their IRAs to make sure it's the right, vehicle to get them where they want to go. Yeah. Now, most recently during tax season, we were making sure people were aware of all the rules and limitations involving IRAs and trying to work in tandem with their tax professionals to ensure that they're doing all they could for that tax year.
Making sure they follow the rules.
Yeah.
Those are kind of important. What are some of the rules that you're talking about? Give me an example.
Yeah, sure. So, for instance, a lot of people aren't aware that they've got actually until their tax filing deadline to fund these types of IRAs, which was April 18th.
Yeah, they bumped it out this year. It wasn't the 15th like always.
Right. And some IRAs have different deadlines. So, during my reviews with clients throughout the year, I try to find, information about how much money they make, because that can income can affect their limitations, what they can and can't do. If they normally receive a refund, or they normally have to write a check, because that can also
That's me.
well, that can give an indication as to which type of IRA makes the most sense. And, if they handle their own taxes, or they have a professional, so we're very proactive when it comes to deadlines like tax day or end of year planning. So,
Got it. So I know that, Shannon and I, my wife, the producer, we're kind of looking at doing IRAs and all that stuff. And I know that there are actually contribution limits to those, and with 401ks as well. Are you allowed to tell us what those are? I know that compliance, they have a lot of restrictions on what you can and can't say. And very specific on today's show.
We've got the eyes in the sky right now.
I know,
Matt's
Big Brother's watching us.
what he says.
Don't want the black helicopter to land on the roof. No.
And this is a heavily very compliant interview today, segment. So, and I know you've done your due diligence and had everything passed, but any light you can shed on that would be awesome.
Yeah, absolutely. Any person who's under the age of 50 has different rules and limitations in terms of contribution. So somebody under the age of 50 can contribute $5,500 per person per year to either a traditional or Roth IRA, and $18,000 per person per year to a 401k. If they're over the age of 50, they can do what's called a catch-up contribution. So for IRAs, that amount increases to $6,500 per person per year, and with 401ks, it's $24,000 per person per year. But those numbers are subject to change in subsequent years,
depending on what the government decides they want to do.
Right.
Because they're the ones in charge.
That's right.
Okay, so I've heard actually people are saying that they don't qualify to fund an IRA. I don't know what that means, but I've heard people, like when I'm sitting down with Dan sometimes and we're meeting with a buyer, we're going over stuff and we ask them if they have what they have for their retirement stuff. Sometimes they say that. What does that mean, and are they fully educated on that or no?
Well, a lot of times they'll find out after the fact that they don't qualify, and that's the part where, your original question is, does somebody really need a financial advisor? If people can keep up to speed on other rules, maybe not. But because there are so many, your question about, people not qualifying to fund these IRAs, it kind of gets into a tricky conversation because, we start getting into IRS rules. And I always make the disclosure that I don't do taxes and I don't give tax advice, but I will say this, that there are a lot of rules and restrictions surrounding IRAs because someone's income will typically determine what types of IRAs they can fund. So in a conversation with one of my clients, it may go something like this. Mr. and Mrs. Client, based on what you've told me, you may qualify to fund a Roth IRA, but make sure you bring that up in conversation with your tax professional during tax season. And here's why I say that is because the maximum income that someone can make and still fully fund, like a Roth IRA, for instance, at least for last year, was $183,000. So if their tax professional can confirm that, not to get too detailed, but their modified adjusted gross income is below $183,000, then they're fine. Otherwise, if they make more, they really wouldn't qualify. There's only a couple other scenarios where they could actually get money into a Roth.
Okay.
So.
Got it. I'm going to test my knowledge. Okay. See if I'm up to speed on this, because I am not a financial advisor. No. Roth IRA, that's the one where its withdrawals are not subject to taxes. Am I correct?
Correct. Yeah, you can deposit after tax dollars. Good job. And then when you make a withdrawal in retirement, you don't pay taxes on anything that gets removed from the account.
Okay. So, and you just said what those limits were, what you can contribute each year. Remind me what that was again.
Yeah. So if you're under the age of 50, it's $5,500. If you're over, it's $6,500.
And those have no annual income caps or requirements?
No, they do.
They do. That's what you just talked about.
That's the $183,000.
Okay. So let's say I make $350,000 a year. don't qualify. Does my wife, who happens to be self-employed, that doesn't, or am I getting into too many? Am I out of compliance right now?
We're getting into
borderline.
a few details.
Okay,
yeah.
so kids.
I hear that helicopter.
Kids, can you fund Roth IRAs for your kids?
It's one of those questions that is very.
I know.
You got
Helicopter.
Yeah.
It's coming in, Dan.
Okay, I'm gonna set up an appointment with my guy Matt, and we're gonna talk about Dan Keller financial planning.
There you go.
Leave it
There
at
you
that.
go.
Doc, I know I was gonna get in trouble. My producer's over there going, no.
What are you doing, Dan? What
I'm
are
sorry.
you
I went
doing?
rogue for a minute. I'm done.
You did. We talked about this.
I'm done. I know.
Jeez. All right. I know I don't get excited about paying taxes.
Yeah.
I don't know really anyone that does. So if it's not too complex, can you describe other scenarios where people can get money into a Roth?
Sure, absolutely. Yeah. So one way is to, if you make too much, and this might tag along with your previous question. If a person makes too much to fund, say, a Roth IRA. Now, I'll make this disclosure. Restrictions for a traditional IRA and Roth IRA are different. So we're kind of heading down the road of Roth contributions. Okay. So for clarification for the listeners. So one way to get money into a Roth is through a Roth 401k. Now that might surprise some people because not too many people I feel like are aware of this option.
Yeah, I've only heard of a Roth IRA, not a Roth.
Yeah, they're kind of a newer thing. I don't know when they really started becoming more popular, but depending on your specific company, they may offer not only a traditional version of the 401k, but also a Roth 401k. Okay. See, most companies that I come across offer a traditional pre-tax 401k. So the money doesn't get taxed prior to entering the 401k. If a person has a Roth 401k, the money gets taxed first, then goes into the Roth 401k. And so just like the Roth IRA, it's tax-free. Now that option's extremely nice, as I mentioned before, that for people who make too much to fund the Roth because they're no longer subject to this $183,000 income.
Okay.
So I hope that wasn't too in-depth.
Great.
That's good. That's good.
Okay.
That's really good info. So, actually, I'm hearing the outro music. We got to take a break, Matt.
Okay.
We're going to come back after the break. We got Matt Ross, Ross Financial Incorporated, coming back talking about being a financial advisor, how he can help you set up your retirement. So stay tuned after the break.
Stay tuned. There's more Seattle Real Estate Radio coming up here on Business Radio 1300 KKOL. We're back with more Seattle Real Estate Radio with your hosts, Christian Nossum and Dan Keller.
Hello, and welcome back to Seattle Real Estate Radio. We are back here with Matt Ross, who is a financial advisor, and he's educating us on the things that he does to help clients with on a regular basis. So before we went to the break, Matt, kind of had to cut you off. I apologize, but
No worries.
Those traffic reports got to get out there somehow. You were in the middle of telling us about ways to get money into Roth accounts. Can you continue on with that before we get into additional questions?
Yeah, so we were just talking about putting money into Roth 401ks. The next option is the Roth conversion option. And before I jump into that, I've got a quick little disclosure that I need to read here.
Fun.
Right. So every investor situation is unique. You should consider your investment goals, risk tolerance, and time horizon before making any investment. Investing involves risk, and you may incur a profit or loss regardless of strategy selected. Unless certain criteria are met, Roth IRA owners must be 59 and a half or older to have held the IRA for 5 years before tax-free withdrawals are permitted. Additionally, each converted amount is subject to its own 5-year holding period. Investors should consult a tax advisor before deciding to do a conversion. Traditional IRA withdrawals are subject to income taxes and, if withdrawn prior to age 59 and a half, may also be subject to a 10% federal penalty. So,
Compliance.
Yes. So that being said,
Yes.
the topic of Roth conversions, which I find a lot less people are even aware of this option, and it can be a little tricky. And your listeners can always reach out to me to get more clarification on this. So here goes. If someone makes too much money to fund a Roth IRA, what I will have an investor do is fund a regular traditional IRA.
Okay.
But they don't deduct the contribution from their taxes. Because again, if you make too much money, you don't qualify to deduct the contribution on your taxes. Instead, they make a non-deductible IRA contribution and then convert it to a Roth IRA. Now, again, like with so much of what we've talked about today, there's rules surrounding someone's needs to properly execute this type of a transaction. The kicker is this works best if they don't already have a traditional IRA.
Okay.
So is that about as clear as mud?
Totally as clear as mud.
As clear as it could be.
And that is why it pays to meet with you face to face and talk about specific things. So I'm not going, okay, well, does this apply to me? Does this not? And that's, again.
Well,
Right.
and like you said in your disclaimer, your compliant disclosure, every investor's situation is different. That's why it's so important to sit down and talk with Matt, a professional like Matt. I mean, it's just...
it pays to hire professionals.
Yeah, and it's your future. It's your future. I'm excited because I actually get to ping a couple of questions off you now. Are you done, Christian? Are you done?
I'm finally done.
Are you done
I'm
with
done.
the IRA?
Pass it off to you.
So we were talking, over the break and earlier about the simple or SEP versions. Would you explain that to our listeners? Because it's popping up a little bit more, I guess, in my line of work when I'm talking with people. I'm like, go talk to Matt.
Yeah. Well, these are other types of IRAs that I would say aren't as common, but they could be a good fit. Like a simple IRA, could be a good fit for one of my small business owners.
Okay.
I won't go into too much detail, but the company can set one up pretty quickly and allows for contributions up to $12,500 for somebody under the age of 50, and $15,500 for somebody 50 and over.
Okay.
Again, we get into more rules and limitations.
Okay.
And now a SEP IRA, I would most often suggest for somebody who's self-employed, quite oftentimes has no employees. And a good example would be somebody in real estate.
Okay.
Right?
Like me.
There you go. So I know you won't be surprised by this comment, but there's rules regarding all these types of contribution limits and what you can and can't do. I will just say that in the right situation, someone could contribute in a SEP IRA as much as $53,000 per year.
Nice.
So it allows a
Much
bucket.
larger.
Yeah.
So from $5,500 or potentially $6,500 for a Roth IRA, depending on
If
your
you're over
income,
50,
and if you're over or under 50, to $53,000
in a SEP IRA. Yeah.
Wow.
Yeah.
So a big difference.
And the same income restrictions apply?
Everyone's different.
Everyone's
so
different. Okay.
Again, we leave the heavy lifting to the tax professionals to determine what makes sense for people.
Okay.
Quite oftentimes we'll throw out the idea with the caveat of consult your tax professional.
Yep. So what I love about you is you're working in unison with the tax professional, though. So essentially the client comes to talk with you, you give them, which kind of leads into my next question, Matt. So basically you help people determine or brainstorm with them the options that they have to put away money for retirement. That's essentially retirement planning. And then at some point in there, you're then reaching out and working alongside the tax professional.
Absolutely.
So talk to me and let our listeners know a little about how that looks. So client comes in, you're sitting down with them, you're brainstorming with them, their unique situations, and planning for retirement. So explain that. What does planning for retirement mean?
Sure. Well, it's dialogue with them about their specific situation, but we want to make sure that we're being a little bit more detailed than just writing things out on a sheet of paper and saying, well, you look good or you don't look good. We actually use software to help us figure that out. So based on somebody's situation, what amount of money they need to accumulate in order to retire and maintain that same type of lifestyle they're accustomed to. This software allows us to take a number of different assumptions and do future calculations to determine based on their goals, their likelihood of having a successful retirement, which for most people basically is not running out of money.
Mm-hmm.
That's a pretty good plan to have.
Yeah.
Right. That's never a good scenario.
Run out of gas in the mountains.
No,
yeah.
that'd be bad.
Okay. So I guess that you kind of answered my other question, but how do you know? How do you know how much money someone will need? I mean, obviously, it's probably a thorough process that we can't probably get too deep into right now. But is it just that you just relying upon that software? Elaborate on that. How do you know how much money somebody needs?
Yeah, well, for starters, I won't say it's just as arbitrary as picking a number.
Mm-hmm.
Quite oftentimes, I'll have people come to me and say, well, I've heard you need to have this much.
Yeah.
And I say, well, based on what? Is it based on
exactly.
your scenario, your situation? What we do is we set goals based on what they want to accomplish, and we monitor our progress on a very regular basis. I think this is one area that sets my practice apart. It is the regular monitoring.
Yeah.
It's kind of like a GPS. Most people don't just plug in an address and expect that they're going to arrive exactly when it says that they're going to arrive. There's a lot of variables that people are going to deal with.
Makes sense.
Yeah, anytime I get to hang out with you, I love it. We had you actually come in and talk at one of our Wine and Wisdom events for my clients. I invited a lot of my my VIP clients to just come in and chat investment, retirement planning, and a lot of the, I don't want to say analogies, but how you talk so clean and clear and precise about financial planning. And so everybody's situation's different. I highly recommend that you on SeattleRealEstateRadio.com, you're going to be able to reach out to Matt and have that personal one-on-one conversation with him. I want to ask you, so would you say that once people get retired, or once they retire, a lot of the hard work is over?
No, actually, on the contrary. Being retired brings its own set of challenges.
Okay.
We try to help people generate income the most cost-effective way with the least amount of tax implications, all the while trying to maintain the appropriate amount of risk in their portfolio. There's plenty of times where a client will call and request money from their account, and after I ask a series of questions, I might suggest pulling money from a different account or tapping into a different asset that they own. And being in contact with a client on a regular basis allows me to hopefully be prepared for the expenses that they'll have down the road. Most oftentimes, people are going to know when they need to, replace a vehicle or put a new roof on the house or take a vacation that they've always wanted to. And then once a client gets to the age of 70 and a half, the IRS requires investors start withdrawing money from their IRAs. And so, that withdrawal is called an RMD. So, we're not out of the woods once people, get to retirement.
Okay, so I've never heard of an RMD. Am I okay to ask you? Can you elaborate a little bit more on that?
Yeah, okay. Absolutely. So it's an accurate acronym.
We still need that acronym.
Right.
We got a soundboard, and I really want one. So yeah, we got to make that happen.
Yeah. So another acronym, RMD, it stands for Required Minimum Distribution. So when a client retires and they move their pre-tax company retirement plan to a pre-tax IRA, which is called a traditional IRA. They're then required at the age of 70 and a half to start taking distributions from it in an amount that the IRS determines. Now, I won't go into too much detail, but it allows the IRS to start receiving taxes on that money that a client has never paid taxes on. So we help them calculate how much that distribution will be, make sure they take it by the deadline, because an RMD not taken by the correct deadline can receive up to a 50% penalty. So that's something we want to make sure that people don't overlook.
Yeah. So, Dan, I know you got more questions, but I want to get some contact info out for Matt.
Yeah,
so if you've ever wondered if your 401k is invested to match your goals, how about if you're even on track for retirement? Well, Matt focuses his practice on helping individual investors and business owners such as you with planning for retirement. Matt consults his clients on a variety of topics, including IRAs, company retirement plans, insurance protection, estate planning considerations, wealth management, and many other topics. Most people seem to know what they would like their retirement to look like, but they're not quite sure how to make it a reality. If you have at least $100,000 of investable assets, Matt will meet with you for an hour at no cost. That's pretty damn nice. So thank you. He can be reached at his office at 425-357-0400. That's 425-357-0400. Or through his website at rossfinancialinc.com. That's rossfinancialinc.com. Or you can always find him on Facebook, Twitter, or LinkedIn.
Yeah, so, one of the final questions I was going to ask you, which we kind of covered in that little debriefing, but you do a lot of other things for your clients, and Christian, you just hit on a lot of those. But in the last 30 to 45 seconds, anything you want to talk on in regards to other things that you do with and for your clients?
Sure. Yeah. I feel like we need to watch out not only for clients' investments, but also helping them with their nest egg. So we consult on how much life insurance they need, pay attention to their debts, give them guidance on paying things off. Cool. Sometimes they've got kids that need help with certain types of accounts. So it's really a holistic approach.
Perfect. Well, thank you, Matt. Yeah. We got to take a quick break. Stay tuned for more Seattle Real Estate Radio.
Stay tuned. There's more Seattle Real Estate Radio coming up here on Business Radio 1300 KKOL.